Hi, folks. This is Mike Zlotnik, Big Mike, and today's discussion is going to be pros and cons of investing in real estate funds and syndications. Before we jump into the details, the usual disclaimer. This presentation is for informational, educational purposes only. There's no advice given, no solicitation of any kind. Before making any investment decisions, consult with your attorney and CPA professionals. And if you're interested in our family of funds, request PPM, private placement memorandum, to accredit investors only. Now let's jump into the discussion. So why folks consider investing in real estate funds and syndications? What are the main benefits? So the main benefits is expertise of the fund manager or an operator or syndicator. You're investing with folks who hopefully you know, like, and trust. This is a critical requirement. It's very difficult to write a check before you establish know, like, and trust. But once you establish like and trust, you've done your due diligence on a given syndicator or an operator, you feel confident they're worth your consideration for your investment, you can actually consider writing a check. But the first point of comparison between funds and syndications is, what's the major difference? Well, let me explain. So number one, syndication, you can actually evaluate on the merits of a specific underwriting. So when you're looking at a syndication, typically looking at a specific location, specific strategy, specific economics, specific cash flow, specific target returns, specific risks, all that stuff you can do in the underwriting of a given syndication. So one of the strengths of a syndication is you can actually look at the specifics of the deal. And a syndication typically happens at a point of time, and it's usually one asset. Sometimes syndication involves multiple assets, 2 or 3 assets, but it's a single point of time, an asset that you can understand, you can actually feel comfortable with due diligence as part of your underwriting, right? Now let's compare and contrast that to funds. So funds in general have many assets in comparison to a syndication. And funds also acquire assets over time. These are the major differences between the two. Now, we'll talk about how you participate in syndication in a fund, but just a high level. Funds spread the capital of the fund that gets raised over many investments, and it takes place in time. Today, in a month, 3 months, and so on and so forth. Some funds function as open-ended, some function as closed-ended. Open-ended typically keep raising capital, deploying it, capital comes back from the deals, and those dollars get redeployed again. Closed-ended funds just raise capital during a certain amount of time, or they reach certain maximum amount of capital that they are allowed to raise, and they close, the capital gets deployed, and then the investments go through their life cycle. And once every one of those investments sells, exits, the capital comes back over time, investors get back, hopefully, their principal and strong returns. That's how they function. Also, funds can have income strategy or growth strategy. Syndications could also have income or growth strategy. Income-focused funds could distribute income every quarter or periodically. The same happens with syndications. Income-focused syndications distribute cash flow as you go, and then on the back end, when the deal sells, there are profits that get split. So those are just a high-level comparison. There's a very important benefit of investing in an existing fund with existing portfolio. As an investor, you can actually request fund manager to produce the entire portfolio of the fund, everything that's been invested in, and understand what was the investment, when the investment was made, into what property, what are the target cash flows, what are the target total return or IRR, what is the projected exit time. So you can actually, as an investor, you can do due diligence on the fund details, on the fund portfolio before you make investment decision. It is pretty similar to the concept that you do a due diligence on a single asset. Now, as a very intelligent investor, you can actually give yourself the same opportunity to review existing portfolio, and you can ask the questions, how is each asset performing? You can request that information, and hopefully you get the answer. Because if you're not getting the answers from a fund manager on how its portfolio is doing, do they have any performing, underperforming, or distressed assets in the portfolio? If they're giving you the information, wonderful, you can assess. Please be aware that the funds need to be judged in aggregate, not if they have 1 or 2 assets that are underperforming or distressed, but one wide majority is performing, it doesn't mean the fund is in trouble. Actually, in the normal course of business, general expectation is some assets, some investments may underperform or some may get distressed. But as long as in aggregate, the portfolio is doing well, that's what you're looking for when you're considering a fund. And this benefit, and this feature, or whatever you want to call it, that you can actually ask a fund manager to give you the details of what's in the fund, is a critical piece of the underwriting. So it gives you the ability to understand what the fund invests in, where, how these assets are performing, what kind of cash flow, total return, risk profile, and so on and so forth. So now let's talk a little bit about, there are a few different types of funds, and we'll discover how they're different. So there are two major kind of areas. One, let's call them diversified funds. So diversified funds are the funds that deploy capital among many strategies like multifamily, self-storage, industrial, shopping plazas, and so on. And they could also deploy the capital in different locations around the country, different markets, different regions. They also can deploy capital with different operators. They also can diversify among debt investments, basically making loans on deals, and equity investments, participating in equity upside, common equity or preferred equity. Diversified funds have a critical benefit that they spread the risk among many investments. And one of the most important risk mitigation strategies is diversification. So spreading the risk among many investments, among many dimensions of diversification, is a very powerful strategy that mitigates the risk. One of the major drawbacks of a syndication is concentration. When you invest in syndication, you have a concentrated risk in that single asset or two assets or whatever the syndication is. You're concentrated in the performance of that investment. If that investment does great, you can have a massive home run. And if that investment fails, you could lose all your principal. So this is a major distinction between funds and syndications, especially diversified funds and syndications. Now let's go back to another type of fund. Let's just call them concentrated strategy funds. So you have diversified funds, broadly diversified funds, and you have concentrated strategy funds. So what is a concentrated strategy fund? That fund could be a self-storage fund, a multifamily fund, shopping plaza fund, an industrial fund. It's all they do is a single strategy. You also sometimes see single location concentrated funds. There are funds that are built around where the manager is comfortable to invest. And a manager may be comfortable to invest into many things, but in a given area. So those funds are single location concentrated funds. They spread the risk among multiple assets, but they're all in the same area, right? Or they spread the capital among multiple assets, but they're all same type of asset type. As I said, multifamily or storage. So let's call them broadly diversified versus concentrated strategy or concentrated location type of funds, right? But they're both funds. And their major benefit is spreading the risk among many investments. Now you're going to ask me, what are the benefits of the funds besides diversification? Well, one of the really important benefits, probably the most consideration you're giving funds, is again, you're investing in the expertise of the manager, in their knowledge, their network, their ability to source deals, their ability to underwrite deals, ability to manage deals, manage portfolios. You are investing with people. So you could be good, you could be great. If you are great enough to be an active operator, you have the time and energy to be an active investor, and you can acquire assets yourself and manage them, so much more power to you. I salute you. That's wonderful. But you are essentially becoming an active. This becomes your trade. This becomes your business. You become a real estate professional investor, concentrate whatever strategy. So wonderful. But if you are busy, you are a professional doing something else, you may choose to be just a passive investor, a limited partner in the funds or syndications, investing with the professionals, with the experts. And you are obviously trusting the expertise and their knowledge to be able to generate returns that meet your objectives. At the end of the day, each fund has different type of strategy and different type of returns. And you need to understand the risk reward profile of each fund and each syndication. Very important. Part of the underwriting is to understand what is the asset model of the fund, what is the fund invest in, and what are the risks of his investments, and what are the upside. And does the fund have a fair structure that rewards investors commensurate with their level of risk and compensates the manager in a fair manner? So is it a fair shake for investor? Is it a fair shake for the manager? So that question, by the way, comes up on both funds and syndications. So the underwriting process of understanding what the fund invests in is very, very important because it will help you as an investor understand what are projected cash flows, what are the projected total returns, what are the risks, what's the duration of the timeline, how long the money is going to be out, so on and so forth. Syndication is just a one deal. Fund is multiple deals. There's a general, but they behave in a similar manner. If you're investing in real estate for multiple years, you get to understand what you're investing into, how is it going to feed, how is it going to meet your investment objectives. So before you actually decide to consider a fund or syndication, you should hopefully have gone through the planning process. You built, in a matter of speaking, a blueprint for your portfolio, for your goals. What are your investment return objectives, your cash flows, your need for tax efficiency? Some funds and some syndications have great tax efficiency, and you're investing to get some of these tax benefits. So if you know what you're looking for, you know your goals, you know your risk tolerance, you know your comfort level with a different location, different strategy, that will help you pick and choose the right funds or syndications that meet your goals. So back to the syndication. So syndications is a powerful way to potentially enhance your returns above returns of a fund. So something interesting happens. Compare and contrast syndications to funds. If you go look at the typically target returns for a fund versus a syndication, the funds, generally speaking, might have somewhat lighter return targets than a given syndication. Given syndication, for example, might give you a return target of 17%, and a fund might give you a return target of 14%. And you're going to look at this and you're going to say, oh, it's wonderful. I'll take 17% all day long versus 14%. Well, understand the difference. 17% is, first of all, it's a pro forma or projected target return. It's not guaranteed. It is a number that is based on the estimates of the underwriting. Some operators and sponsors are conservative in their estimates, and some are aggressive, and they put higher numbers on purpose to make it more marketable. It becomes a bright and shiny object. And I want to take this opportunity to caution folks looking at the bright and shiny objects. Be very careful with the deals that are underwritten with these phenomenal returns. Well, the reason is that you're probably taking a lot of risk, and assumptions could be very, very aggressive. On the other side, conservative fund managers and syndicators don't mind putting together assumptions that are realistic, more conservative in nature, but it's harder to raise capital because they don't look as attractive. The returns are not as appealing. Something to keep in mind. This is a strategic point to keep in mind. But again, let me compare and contrast back syndication and the fund and target returns for the sake of the argument. The 70% target in this example is a asset projected target return. What it doesn't impute is the risk. If the deal fails completely, what would be the loss on the deal? 100% of the capital. If you had the deal run 100 times, some number of these iterations could fail. So the fund may automatically adjust for the risk because the fund writes a check and it assumes some of them will fail. It has a loss reserve or a risk adjustment for some of these deals going bad. So all other things being equal, generally, a fund should have a target return somewhat lower than a syndication because the fund manager, at least the prudent fund manager, would know that there is some possibility of deals going bad, and they have to assume some capital will be lost as a result of those deals going bad. So that's the risk adjustment or loss reserve that gets applied to compute target return in a fund. So some funds do come up with the high return targets, and I'm obviously not a big fan of aggressive underwriting. My position is you're better off with conservative underwriting, staying away from bright and shiny objects. That's my philosophy on investing. Sometimes deals malfunction. Some perfectly looking syndications at the beginning could fail for reasons outside of the control of the manager, some of the in control of the manager. So I'll give you some examples. You have to be really vividly aware that single asset syndication could succeed enormously or fail. I've seen examples. single asset syndications tripling in 3 years, doubling in 2 years, or doing really well. And in some cases, you see an investment failing completely and losing all the capital. And the reason it happens is a lot of variance and a little risk associated with whatever the plan of that deal. Example could be value add strategy, construction, lease up, management. All these issues could go well or they can go terribly. So as an investor, you have to be aware, you have to be prudent in your diversification, understanding that any single asset investment doesn't have to be syndication. It could be investing in a single turnkey property or anything that could go wrong. Something could go catastrophically wrong with any investment. That's why consideration for diversified funds is that their benefit is that they make the volatility typically lower versus a single asset syndication. So your average rate of return, if you did 30 syndications and a fund that invests in 30 deals, on average, they may work out to be the same. But the fund naturally diversifies price risk, while a syndication has more upside potential, but it has also a risk of a complete loss of capital. It's the high level comparison, contrast and comparison. Just for sake of the kind of disclosure, I've seen single strategy funds fail too. So single strategy, anything could have a problem. We live in a post-COVID world, and office space has been beaten up. So you could be invested in a fund that is concentrated in office, and that whole fund could be in a massive, massive distress. Also, we've seen Bernie Madoff situations where there's a fund and there's a dishonest fund manager or an operator where they cook the books. They run a Ponzi scheme or something like this. So you can have even a fund fail in some of these examples. I'm not saying this to discourage you. I'm just saying that you have to be prudent and continue to diversify among multiple funds, multiple strategies, many dimensions of the diversifications for the reason that you don't know what's going to be a success, a home run, or what's going to fail. So learn how to diversify well, understand the differences. It's a journey. It's not a perfect environment, but if you do it well, if you learn well, it becomes a fun journey, fun adventure with great returns, great experience. And I hope this helps. Until the next time, thank you kindly.